France just dealt a debt shock to the euro's safe core, and silver is behaving like a market that knows something is coming before the headlines admit it. The conflict is simple. Officials and institutions want you to believe this is contained, procedural, and manageable, while the price action, and more importantly, the plumbing behind the price action, keeps flashing stress. And the hidden mechanism most people miss is not a speech, not a vote, not a rating. It's the spread. It's collateral. It's where the metal is physically sitting. And if you stay with me to the end, I'll lay out the exact near-term checklist, levels, timing windows, and what would actually invalidate the whole idea. So you're just not trading feelings in the middle of a volatility ambush. Right now, there's a narrative trap being set for retail investors, and it's incredibly effective because it feels reasonable. The trap is calling France just politics. Another budget fight, another pension argument, another round of parliamentary theater. The market shrugs, commentators shrug, and people who don't live in the bond market file it under noise. But sovereign debt doesn't move like a social media outrage cycle. It moves like plumbing. Slowly at first, then suddenly. And when the plumbing starts squealing, everybody who needs liquidity starts reaching for the same valve. That's where the real pressure starts. Because France isn't a side character. France is a pillar. French government bonds are not just an investment. They're used as collateral, as balance sheet ballast, as the kind of asset you post when you need funding and you want the other side to say yes. When that pillar looks shakier, the system doesn't wait for a headline. It reprices the terms of trust. And once trust reprices, capital starts searching for hedges that are outside the political negotiation. Gold does it first. Silver does it louder. But that's not the part that matters. The part that matters is that silver is not acting like a sleepy commodity. It's acting like a market that's thin in the wrong places, tight in the wrong locations, and prone to bursts of forced buying. Early January has seen silver hovering in the high 70s to low 80s per ounce, with sharp swings that feel less like opinions and more like positioning getting jerked around by market structure. You can feel it in the speed of the moves. You can feel it in how fast dips get bought and how quickly rallies snap back. Volatility is not the absence of conviction. In markets like this, volatility is the fingerprint of constraint. And the next detail is what flips the whole setup. Here is the hidden detail that reframes the whole story. The silver market can be well supplied globally and still behave like it all short, because the benchmark price is set where the metal isn't. If London inventories are unusually thin while metal is sitting in US vaults, the benchmark can get squeezed. And squeezes don't need conspiracy. They only need imbalance and urgency. That nests the kind of setup where a single week of demand can move the price far more than anyone expects. And when you combine that with policy uncertainty that discourages metal from moving back where it might be, the market fragments. Fragmentation is where the tape becomes violent. Because if this one valve sticks, the math changes. Now layer France on top of that. France has a pension and social spending structure that, politically, has proven hard to compress without backlash. What's changed isn't that pensions suddenly exist. What hasn't changed is that the political system is openly signaling limits on austerity, right when investors and ratings agencies are leaning in. A suspension or freezing of pension reforms, especially tied to budget negotiations, tells the market something blunt. The adjustment path is constrained by politics. And the market doesn't care why you can't do it. The market only cares that you can't do it. That's where sovereign spreads start to widen, not because everyone suddenly panics, but because investors ask for a higher premium to hold the paper. And in early January, the French-German 10-year spread has been hovering around the low 70 basis point area, give or take, rather than behaving like the tight and unquestioned core it wants to be. That number sounds small until you understand what it represents. It is the price of doubt inside a currency union. It is the market quietly voting on whether France is Germany-like or the next problem. This is how Contagion starts in the euro area, not with a bang, with a basis point. Here's why the timing is dangerous right now. January is when mechanical flows slam into thin liquidity. Funds rebalance. Risk budgets reset. Some desks are still understaffed. People are still stepping back in. And when liquidity is thin, small imbalances create exaggerated candles. On top of that, you're just coming out of year-end and into a fresh calendar where policy deadlines, budget votes, and negotiations suddenly matter again. It's not that markets wake up in January. It's that the market's forced trades resume. And forced trades don't negotiate with your narrative. So the why now trigger isn't just France, it's the calendar. It's the re-engagement of bond desks after the holiday lull. It's the return of funding markets to normal hours. It's the restart of budget talks under the threat of government instability. It is also the way commodities behave early in the year when positioning is resetting and the market is trying to discover where the true marginal buyer is. And if you're not watching those triggers, you'll think the move is random. It's not random, it's mechanical. Now let's walk the chain reaction step by step, because this is where people get lost and start either hand-waving or shouting. Sovereign stress widens spreads. Wider spreads raise funding costs and tighten financial conditions. Tighter conditions pressure growth and make deficits harder to shrink. Harder deficits feed the spread again. That's the loop. Inside a currency union, that loop gets uglier because you can't just devalue your own currency to regain breathing room. You either get fiscal transfers, central bank support, or political fracture. Markets are constantly pricing which one is more likely, but that's not the part that matters. The part that matters is what institutions do when that loop gets louder. They hedge. They shorten duration. They rotate into assets that historically survive currency credibility stress. They buy volatility. They buy insurance. And in that rotation, precious metals get a bid, not because everyone thinks the world ends, but because metals are one of the few hedges that dawn at tea require faith in a single issuer S balance sheet. Silver is the interesting one because it sits on two rails at the same time. It's a monetary hedge when confidence shakes, and it's an industrial metal when supply chains tighten and demand grows. That double identity is why it doesn't climb like a staircase. It erupts, it whips, it punishes in patience. And then it reprices the entire range when people finally realize the move wasn't emotional. It was math. Now, if you want to understand why silver can move faster than gold in these moments, you have to talk market structure. Silver is smaller, it's less liquid, it's more sensitive to where inventories are located, it's more vulnerable to squeezes when a key pool of deliverable supply gets thin, and the market has been openly discussing a wrong place problem. Metal sitting in one region, while the benchmark relies on another region for liquidity and delivery convenience. That creates a situation where the price can gap, not because there's no silver on planet Earth, but because there isn't enough silver where the market needs it at that moment. And that's where the real pressure starts. Think of it like a city with plenty of water and reservoirs outside town, but a broken pipe feeding the downtown district. The city doesn't run out of water. Downtown runs out of water. The price of water downtown goes insane. Then the plumbing gets fixed and the price collapses. In markets, that plumbing is vault location, delivery rules, and the speed at which metal can move without friction. And friction is what makes squeezes. So when you see silver whipping around early January, don't automatically interpret it as the thesis failing. Interpret it as the market revealing constraint. The question is not, is there enough silver globally? The question is there enough silver in the benchmark system at the right moment under the current policy and tariff uncertainty with participants reluctant to release buffers? Just us. Because if buffers get hoarded, liquidity becomes fake. And fake liquidity is where price discovery becomes violent. Now add the other layer, China. New export licensing or approval requirements on outbound shipments can fragment supply flows and add friction. Again, it doesn't mean silver disappears. It means the market becomes less smooth and more regional. Regional markets don't share inventory easily. That increases the odds of localized tightness. Localized tightness is exactly how you get spikes and air pockets. The next detail is what flips the whole setup. Because once you have a market prone to squeezes, you have to watch options. Silver doesn't just move in spot, it moves through derivatives. And in derivatives, there is a reflexive engine that can turn a normal breakout into a runaway. Here is the simplest way to understand it without jargon. When a lot of call options exist at certain strike prices and price starts pushing into that zone, the dealers who sold those calls often hedge by buying the underlying. The higher price goes, the more they have to hedge. That hedging becomes buying pressure. Buying pressure pushes price higher, which forces more hedging. That loop is a gamma-style feedback. It doesn't happen every day, but when it happens, it feels like the market teleports through levels. And when the market teleports, the media calls it mania. But the reality is often that market makers are doing risk management. They're not making a directional bet. They're trying not to get run over. That's why it can reverse sharply too. If price falls back below the same strikes, hedges get unwound, and selling accelerates. This is why silver can be both the most thrilling chart on your screen and the most emotionally dangerous one. And if you don't respect that, volatility will use you for exit liquidity. Now let's stack the evidence, because one argument is not enough in a market like this. You need layers. Layer one, the sovereign stress signal. When France's spread to Germany refuses to behave like a calm core asset, it tells you investors are not treating this as background noise. A spread is not a politician speaking. A spread is money demanding compensation. Layer two, the political constraint signal. Suspending or freezing pension reform to keep a minority government afloat is a clear admission that fiscal adjustment is politically capped. It's not a moral judgment, it's a constraint. Markets price constraints. Layer three, the funding and balance sheet channel. Banks and institutions hold sovereign bonds as high-quality liquid assets. When yields rise or spreads widen, those holdings can become less comfortable. Funding costs can tick up and risk appetite can contract. In a fragile macro environment, contraction matters quickly. Layer 4, the macro hedge bid. When the euro area looks less cohesive, global investors hedge currency and rate uncertainty. Precious metals historically respond to that mix, especially when real yields look vulnerable to policy shifts. Layer 5, the silver-specific tightness risk. If benchmark inventories are thin where pricing is set and metal is stuck elsewhere due to policy uncertainty or incentives to hoard, squeezes become easier. That's not speculation. That's how any deliverable market behaves when the deliverable pool shrinks. Layer 6, the calendar. January flows, restarting negotiations, and thin liquidity create a window where mechanical trades can push the market into zones that trigger options reflexivity or short covering. You don't need everyone to agree, you just need a chain of forced actions. And that's the key phrase, forced actions. Because price doesn't move when people think. Price moves when people must hedge, must cover, must rebalance, must meet margin, must source physical, must roll positions, must defend a risk limit. And that's where the real pressure starts. Now let's talk about the number in the title, because $280 silver sounds like fantasy until you define it properly. It's not a guarantee, it's not a promise. It's a scenario endpoint based on ratio math under a regime shift. The way silver gets to numbers that shock people is not by climbing calmly. It gets there when the gold-silver ratio compresses hard during a phase where gold is being treated as a reserve hedge, and silver is simultaneously being treated as scarce, volatile, and industrially strategic. You have already seen major institutions projecting much higher gold prices into late 2026, numbers in the several thousand range. If gold were to reach, say, around $4,800 in a risk-on-to-risk-off macro transition with central bank buying and lower real rates, and if the gold-silver ratio were to compress to 25, that implies silver around $192. If the ratio compresses to 20, that implies $240. And if the ratio compresses to the high teens, a level seen in certain historical stress or commodity cycles, that math points near $280. That S the arithmetic. The debate is not whether the arithmetic works. The debate is what macro and market structure conditions would be required to force that ratio compression. And that's where France and EU contagion matter. Because a currency credibility episode doesn't just lift gold, it can lift the whole complex and tighten the ratio if silver as physical constraints and industrial bid collide with investor hedging demand. In other words, $280 isn't inevitable like gravity. It's also inevitable only if the system keeps choosing the path that makes hedging demand collide with constrained liquidity. If you see the ingredients, the math becomes plausible. But that's not the part that matters. The part that matters is what you do this week and next week, because that's where most people get chopped up. So here's the near-term roadmap, and I'm going to be very specific without pretending to have supernatural precision. First, watch silver's behavior around the low 80s zone, that S, the psychological line where the market either accepts higher prices or rejects them with a fast liquidation. If price can hold above that zone after a pullback, meaning it dips, finds buyers, and reclaims the level without panic, that's confirmation that the bid is structural, not just a squeeze spike. Second, watch the high 70s as the battle zone. In a volatile market, you don't need perfect levels. You need zones. If silver starts spending time below the high 70s and can't reclaim them, that suggests either the physical tightness is easing or the derivatives feedback is unwinding. That doesn't mean the longer thesis dies, but it does mean the near-term path changes. Third, watch the late December spike behavior as a reference point. Silver showed it can move violently into the upper 70s and low 80s and then reverse. That's a market telling you liquidity is thin. Thin liquidity means gaps. Gaps mean your risk plan matters more than your opinion. Now on the France side, watch the spread. Not the speech, not the press conference, the spread. If the France-Germany spread tightens decisively, meaning it compresses and stays compressed, that S the market signaling reduced fragmentation risk. That would weaken the contagion fuel. If the spread widens meaningfully and persists, that's the market saying the fiscal and political constraint is not a one-day story. That supports the hedge bid backdrop. Also watch the calendar around budget votes, no confidence threats, and negotiations. When governments operate with narrow margins and the threat of collapse, markets price a premium for uncertainty. Even if nothing bad happens, the premium can persist. And persistently, higher risk premium is exactly what pushes investors to hedge. But that's not the part that matters. The part that matters is the two-scenario lens, because it keeps you honest, and it keeps you from turning into a maximalist at the worst moment. Scenario 1 is the controlled pullback and retest. Silver pulls back sharply, maybe even aggressively, shaking out weak hands, then finds support in the high 70s, consolidates and grinds back toward the low 80s. In this scenario, volatility is high but the structure holds. The market is building a base at higher levels. Confirmation looks like dips being bought quickly. spreads staying elevated and the market refusing to spend time under key zones. Scenario 2 is the continuation squeeze and gap risk. Silver pushes through the low 80s with speed, runs into option strikes, triggers dealer hedging, and gaps higher in a way that feels irrational. In this scenario, your biggest enemy is not being right or wrong. Your biggest enemy is chasing, because squeezes can reverse just as violently as they rise when hedges unwind or when physical tightness eases for a moment. Both scenarios can make money for disciplined traders and investors. Both scenarios can destroy emotionally reactive accounts, and that's where the real pressure starts. So let's build the viewer psychology shield, because this is the part that separates people who survive volatility from people who become a cautionary screenshot. The market will try to manipulate you emotionally, even without anyone manipulating anything. Volatility itself is a psychological weapon. It makes you doubt your analysis at the bottom, and it makes you overcommit at the top. It makes you take profit too early in a trend, and it makes you add too late into exhaustion. It makes you interpret noise as signal, and it makes you interpret a normal retest as betrayal. Your job is to separate trend signal from noise. Trend signal is structure. Higher zones holding, spreads confirming, physical constraints persisting, and the market reacting to bad news with less downside. Noise is intraday violence, liquidation wicks, and social media certainty. If you're holding a longer horizon view, the question you should ask during a violent dip is not, am I scared? The question is, did the invalidation trigger happen? Because fear is not an invalidation. A headline is not an invalidation. An invalidation is a structural break that changes the probability stack. So what would actually invalidate the more aggressive 208 pathway narrative? Here are the clean ones. 1, a decisive easing of physical tightness, meaning metal flows back into the benchmark pools and squeezes stop being possible. If inventories normalize where the benchmark is set and liquidity thickens, silver can still rise, but the teleport dynamics diminish. 2, a sustained compression in euro area fragmentation signals, meaning spreads tighten, political risk premiums fade, and the urgency to hedge currency credibility risk cools. If the core looks stable again, some of the macro fuel disappears. 3, a macro regime shift where real rates rise sharply and persist, tightening financial conditions in a way that crushes speculative and hedge demand across metals. Metals can survive higher rates at times, but a sharp, sustained rise is a headwind you must respect. Those are the invalidation lanes. Notice what's not on the list. Your feelings, a one-day candle, or a commentator calling the move overextended. That's not data, that's noise wearing a suit, and that's not the part that matters. Now let's bring it back to France, because the title isn't about silver in isolation. It asks about the mechanism that turns a pension crisis into a debt death blow narrative. The phrase sounds dramatic, but the mechanism is sober. If a government's ability to reform is politically capped, deficits persist. If deficits persist, debt dynamics worsen. If debt dynamics worsen, markets demand higher premium. If premium rises, debt service costs rise. And higher debt service costs crowd out other spending, which increases political stress, which makes reform even harder. It's reflexive. And reflexive loops don't need villains, they only need constraints. In a euro area context, that reflexive loop can leak across borders because banks and institutions are interconnected, because portfolios are benchmarked, because risk models treat core differently, and because when core wobbles, the entire pricing of European risk can shift. That doesn't mean the euro collapses tomorrow. It means the hedging bid stays alive, and in markets, staying alive is enough to move prices. Also, consider the incentive structure. Politicians face elections, coalitions, and social stability. Investors face mark-to-market, risk limits, and funding. The politician's job is to delay pain. The investor's job is to price pain early. When those incentives collide, spreads move first. Then currencies, then hedges, then commodities with thin liquidity. And that's where the real pressure starts. So what do you watch next week? In plain language, watch whether silver can keep holding higher zones after it gets slapped. In a squeeze-prone market, slapdowns are normal. If each slapdown gets bought sooner, that's bullish. If slapdowns start lasting longer and rebounds weaken, that's a warning. Watch whether the euro area spread story cools or heats. Cooling undermines the contagion accelerant. Heating reinforces it. Watch policy clarity around trade and tariffs that affects where metal sits. If uncertainty persists and metal stays stranded in one region, volatility persists. If clarity arrives and metal flows back smoothly, volatility can drop, and price can retrace even if the longer trend remains. Watch the options calendar. When you're near heavy positioning zones, the market can behave like it's glued to a level, then suddenly leap when it breaks. If you don't know why it leapt, you'll invent stories. Don't invent stories. Track the mechanics. And above all, remember this. Price can whip around violently even if the thesis is correct. That's not a bug. That's the feature of a market where liquidity is the constraint and positioning is the accelerant. The goal isn't to predict every candle. The goal is to stay aligned with the pressure map and not get emotionally liquidated. Now, about the inevitable word, use it carefully. The market doesn't owe anyone inevitability. What you can say credibly is that the setup contains ingredients that have historically produced outsized moves. Sovereign uncertainty, fragmentation, signals a thin and sensitive silver market, policy-driven friction in supply flows, and an option structure capable of reflexive acceleration. That combination is rare. When rare combinations appear, markets pay you not for being loud, but for being early and disciplined. But that's not the part that matters. The part that matters is your process. If you're the kind of investor who wants to outlast the next decade of institutional games, you don't need to win every week. You need to stop being harvestable. You need to stop letting volatility narrate your identity. You need a checklist, a risk plan, and a calm respect for how quickly silver can humble a confident account. So here's your compact identity anchor, because this is the subtle CTA that actually matters. Be the person who tracks the spread, the structure, and the schedule. Spread, the France-Germany stress signal and broader euro area fragmentation. Structure, silver's behavior around key zones and the signs of tightness versus easing. Schedule, the calendar triggers, budget negotiations, policy deadlines, and options windows when forced flows hit. If you do that, you won't need permission from mainstream commentary to take the market seriously. You'll see the pressure before it becomes a headline. You'll recognize a squeeze before it becomes a story. And you'll know exactly what would break your thesis before your emotions do. And if the market decides to deliver the more extreme pathway, if gold continues toward the multi-thousand zone, if the ratio compresses, if silver's tightness persists, if euro area stress stays alive, then the 280 number stops sounding like fantasy and starts sounding like a scenario that the math can justify. Not guaranteed, not promised, but mechanically plausible under the right regime. Because this move isn't emotion, it's math. And now you know what to watch next.